Okay, welcome to Unit 16. This is quite a large chapter, the real estate appraisal. We're going to probably split this into 3 separate videos. And basically we'll be talking about the 3 different types of appraisal, how you would do them, and that is the sales comparison approach, the cost appreciation approach, and the income approach. We're just going to do a quick refresher from earlier when we were talking about A bar sale, of which one of the A's represented appraisals, which we are allowed to do as a licensed agent. And the basic questions come up here. Can we perform an appraisal? Well, the answer is yes. Can we charge for an appraisal? The answer is yes. How do we charge? Well, we don't charge a commission. We charge on a per job basis. Can we do one from a bank or for a federally related transaction? No, we cannot. And how do we do it? We do it according to the Uspap. Can I call myself a certified appraiser? No. Can I call what I do a certified appraisal? No. You need to make sure that your customer or client is aware of that. And finally, how do I get paid? I don't personally get paid. Everything has got to go through your broker. Alright, let's carry on. There are rules and regulations pertaining to appraisals. We remember from earlier chapters that 475 is divided into 4 parts, and part 2 is to do with appraisals. But also there are unique entities that deal with appraisals directly, appraisers. The first one is the Appraisal Foundation. And the best way to do that is know that the Qualifications Board and the Standards Board are the 2 main ones. The Qualifications Board, the AQB, looks after the examinations and certificates and determining how to get people qualified. And the Standards Board, they basically are the people that write the Uspap. If you can remember, qualifications means exams and certificates. Standards means the rules and regulations how to do an appraisal. Making this very simple here. We have basically 2 types of appraisers. A certified residential appraiser who is allowed to do 1 to 4 residential units only, and a general appraiser who can do any type of appraisal. We cannot do federally related transactions, and that means including sales, lease, exchanges, financing and so forth. If it involves any of the banks or FHA, VA, Fannie Mae and Freddie Mac are associated with it, we cannot do it. All of those will require the services of a fully certified appraiser. And the appraisal must be done in writing, and it has to conform to the Uspap. This includes any appraisals done for anybody. The Uspap, big old fat book, set of guidelines for appraisal services, requires objective and impartial appraisals. In other words, you shouldn't really be doing an appraisal on a property that you may be buying or selling. It does establish record-keeping requirements, creates confidential appraiser-client relationship, and it's unethical to accept compensation based on value. There's a copy of the front page of the latest Uspap. It's a big, thick book. So you can do it. It's covered under A bar sale. And remember, we also do CMAs and BPOs, comparative market analysis and broker price opinions. They are not appraisals, therefore they don't have to comply with the Uspap, and they cannot be called appraisals. Alright, let's have a quick look here and understand the difference between cost, price and value. How much did something cost? How much did the materials, how much did the labor cost to build this house? That's my cost price. We've all heard that. What am I selling it for? What is the price I'm going to sell it for? What is the price that the buyer is going to pay? but what is the actual value? They may all be the same, but it's highly unlikely. The price and the value may be the same, but not necessarily. I built a house for $200,000. I sold it to my son for $300,000. He had it appraised and it was valued at $400,000. Lucky son. There are different types of value. The assessed value, which is used by the tax assessor's office. The insurance value, which is used for insurance companies for replacement of the improvements, not the land. The investment value, which is a very unique type of value purely to that investor, depending on their own situation. A liquidation value, how much would we get for this property at a quick sale or an auction. A going concern value, which basically adds into the value the fact that the business is operating and so forth. And then we have the salvage value. If the property is no use to anybody, how much is it worth at its end of its life? But the one that we're most concerned with and come across most often is the market value. So the market value is the most probable price which a property should bring in a competitive and open market under all conditions requisite to a fair sale. It assumes that the buyer and the seller are each acting prudently and knowledgeably and for themselves, and the price is not affected by undue stimulus or incentives. So essentially this means that the home has been on the market long enough and advertised enough so that plenty of people have got a chance to look at it and maybe make offers. That time period all depends on what sort of market it is and what sort of property. A commercial property may take years to sell. A popular family home in a hot market may just take 2 or 3 days to sell. And we're talking about the normal financing and normal desires and so forth, that everybody's acting in their own interest. Obviously, my selling my $400,000 home, I forget what it was now, to my son for $300,000 isn't a normal sale. Obviously, I was giving him a bit of a discount. When we actually do appraisals, we have to make an assumptions in the market value. For instance, when I make an appraisal, I've got to base it on a particular date. This is what it's worth today. Next year, or next month, or last month, or last year, it may be differently. May be different. We've got to assume that the buyer and seller are typically motivated, well-informed, advised, acting in their own interests, been on the market for a reasonable time, and payment is made in US dollars or comparable financial arrangements, and not affected by special deals, special financing, or seller concessions. If a seller is willing to give over $20,000 in concessions to the buyer, then that really doesn't represent the market price, because the buyer is probably willing to offer $20,000 more. It's actually only costing the buyer that price that they offered, less $20,000, for instance. What affects value? Well, demand, obviously. When there's more demand, then more people will be after the same property, and there'll be a little bit of an auction going on, highest and best offer, multiple offers, whoever gets the highest price wins. Utility, what is the usefulness? How does it provide the services that I'm used to? If it's a small house with 1 bedroom, or 1 bathroom rather, then maybe it's not so useful as a home with 2 bathrooms. So therefore, even though it's the same size and the same type, it's not providing the same usage as I would like. So that affects the value. Scarcity. Well, once again, that's scarcity on the opposite side of demand. If there's no homes around, then that means the value is going to go up because more people are after the same home. And transferability. It's got to be a clean, marketable title. We don't need anything hanging around in the background, any liens on it, other people claiming ownership. So transferability is very, very important, because when I buy something, I want to buy it free and clear. The whole market system is worked on the principle of substitution. A buyer or an investor will pay no more for a property than the actual cost of acquiring, through purchase or construction, an equally desirable alternative property. And therefore this sets the upper limit of the value. Why would I buy this house for $100,000 when I can actually go and find this house next door for $90,000? Or why would I buy this house for $100,000 when I can go and make my own for $90,000? Obviously, the $100,000 home is overpriced. Here's an example here. In the sales comparison approach, why would I buy this $180,000 home when the home next door is valued at 166 or going for sale for 166? Why would I buy that home when I can build the new one for the same price after depreciation? Income approach, why would I take 9% on this home or 10% when I can actually get 11% for the same amount of money spent on this property? So it's substituting one for the other, which is ever the best. When we look at an appraisal, first of all, we've got to look at the highest and best use. Even though this property is being used for this, it's zoned for something a lot better, and if someone was to come along and use it in its full use for zoning, it would develop more income, therefore it has a higher value. So the most profitable use of a property must be legally permissible, which is usually zoning, physically possible, and then financially feasible. In other words, the finances make sense that I spend this amount of money on the property and I know it's going to give me that sort of return, and that's what our highest and best use is. So all appraisers usually look at everything as a highest and best use. First of all, the appraiser will go along and look at the lump of land and any buildings on it as though the buildings weren't there and it was vacant. What could we do with this lump of land? And the legal use of the site that will produce the greatest value, the potential highest and best use of a site determines its value. You may also look at it as improved. If there is buildings, if there are improvements on it, then how can we develop an income for what is on there? Can we make improvements to that those improvements and get more income, or can we knock down those improvements and put up new ones and see what the income would be there? So it's quite a complicated process with a lot of abstract work to go ahead. We also have the principles of value, increasing and decreasing returns. Over improvement. Don't go and spend a lot on your home because you may not get the money out of it. I'm quite happy to spend $5,000 on repairing and improving the kitchen, and I'll probably get $5,000 or $6,000 increase in value in the home. But if I go and spend $20,000 on an old house in the kitchen, I'm probably not going to get the $20,000 back. And conformity, all homes in similar in size and style and cost. We do like homes around us to look the same. If we're in a mismatch of homes, it does affect the value. We like looking at similar homes and so forth. And I'll just go on to the next couple here. For instance, here, increasing and decreasing returns. Once again, add a new bathroom extra and a pool, $55,000, but the extra home value is only $40,000. So to bring the value up to the other homes in the area to have the same facilities. So why would I pay an extra $55,000 for this home when there's a home next door which has only cost me an extra $40,000? Here's an example of conformity. We like living in areas where everything around us is the same. We don't want a little old lady in a shoe who doesn't know what to do living in our neighborhood, because it's going to disrupt the conformity. We talk about assemblage and plottage. I've got two lots here, 35,000, 35,000, lot 1 and lot 2. They're limited because of zoning and setback requirements. I can only build 2 small homes on each of those lots. If I remove the separating border, adjoining border line there, and make it into one lot, then that means I can actually make a larger house which has got a lot more value, and therefore it will increase the utility of the lot and increase its value. So whereas before the lot was total of the 2 lots was 70,000, I can increase the value by 90. The amount of plottage is the amount that I've increased the value by assemblage, in which case this is 20,000. Progression and regression. There's an old saying, don't be the most expensive house on the block, because, or it's best to be the cheapest house on the block. If I'm the cheapest house, the owner's going to look out over all these nice houses. Therefore, it will increase the value because my view is nicer and the price of my house is brought upwards by the superior properties around me. But the case of regression is I've got a very, very nice house. I'm the king of the castle and all the dirty rascals. But unfortunately, those dirty rascals all around you, when you look out your window, you can see them. That's going to lower the price of the house. So we've got three approaches. We'll talk first of all about the sales comparison approach. I've already done that. When we talk about the sales comparison approach, this is best for vacant lots, single-family dwellings. The income approach is best for income-producing properties, either commercial or homes that are rentable. And the cost approach is how much is it basically going to cost to build the equivalent house, and any special purpose properties where I can't find comparables like community facilities or churches or government buildings and so forth. So we're going to start with the sales comparison approach. And the way we do this is we look at comparable sales in the area on the basis that a buyer is not going to pay any more than what other previous buyers have paid for similar properties in the area. Values are estimated by reviewing recent sales of comparable properties similar to the subject property. Sales must have occurred recently in the same market. It's no good comparing something that sold 2 years ago, 20 miles away. And the properties must be similar to the subject property. Don't compare 2-bedroom homes with 5-bedroom homes. We have to make adjustments also for transactional differences, how much the market price has increased or decreased over the years, and also any property differences of our comparables to the subject property. Are they larger, smaller, got different square footage, more bedrooms, and so forth. The important thing is that when we have our subject property, we don't know what the price of the home is. So we look for similar homes in the area that are sold recently, and then we may have to make adjustments to the sold price because of the differences between the comparable and the subject. We try to make the comparable property the same as ours. So if the subject property, if the comparable property is better, then whatever is making it better, we have to subtract the value of whatever is making it better from the price that the comparable property sold for. CBS. Comparable better, subtract. If the comparable is inferior, then what have we got to do to that comparable to make it the same as my subject property? We have to add whatever it is that's making it inferior. So here's an example here. I've got my subject property, not in the book. Got comparable 1, comparable 2, and comparable 3. I can see that my subject property has got 2 bedrooms and 2 bathrooms, whereas a comparable property number 1 has got 2 bedrooms and only 1 bathroom. The question will give you the value of each of these facilities. In this particular case, a bathroom is worth $5,000. So what have I got to do to comparable 1? To make it the same as the subject property, I have to add a bathroom. Bathroom is 5,000, therefore I add 5,000 to 125,000. We come up with 130. Same with comparable 2. Comparable 2 house is the same, but it does have a swimming pool. We've got to take away a swimming pool, which is worth 7,000. So we take off 7,000 from 134. And the same with 3. This has got an extra bedroom. We add in a bedroom, which is worth 10,000, and then we make it up to we take away a bedroom, I beg your pardon, we take away a bedroom and bring it down. Then we add all these up and average them out, and it comes to 126,000. We've also got to take into account the financing terms. Sometimes there's an FHA loan, sometimes it's seller provided financing, sometimes it's a regular loan. They all affect the value that the buyer is prepared to pay for a home. And the conditions of sale. We have to research. Is this a quick sale? Is it a foreclosure? Is it a short sale? Maybe it's an inter-family sale. They all make differences. And we also have to look at the market conditions. Market conditions are based on whether prices of homes in the area are going up or down. If I'm using a comparable that sold 6 months ago, I have to see what that comparable would have sold to today by looking at the price changes. We also have to look at the square footage, number of bedrooms, and so forth. Also landscaping. If the landscaping is better or worse, we have to make adjustments for that. Then what we do, after we have adjusted all of those differences and got the different prices, we then have to We could add them all together and divide by 3, but what we're going to do is look at each individual comparable, and there may be more than 3, there could be 5 or 6 or even 10. We are going to be looking at that and say how appropriate, how representative is that comparable to my property. Is it close enough? Is it sold recently enough? Is it design similar enough? And so forth. Because sometimes I find it hard to find comparables that absolutely match my subject property, and I've got to go either further afield or back in time, or choose properties that are substantially different, and I have to make those adjustments. So therefore what I do is I take a little percentage of each of the comparable final figures and I apply that to the final price. If a comparable is not so appropriate, then maybe I'll take 20% of that figure. And then I do that with the other comparables, and eventually I'll have 100% of all of the comparables, proportionate amounts, and then I will add up those figures. Here's an example in the book. This is out of the book. We have our subject property and we have our 3 comparable properties. We've decided in the book that the market increases 4% a year and the cost per square foot is $60. So we can make those adjustments when the time comes. For instance, this house sold for $141,500, sold 6 months ago. Well, we know it's 4% a year, so therefore it's going to actually be 2% more because of half a year, which is 6 months. Therefore, I'm going to add on 2% of the sales price, which is $2,830, and that's going to give me a little bit extra. Also, the home is 160 square feet larger. So I'm going to take away 160 by $60 a square foot. I'm going to take off 9,000, and that's going to give me the final value. In this particular case, we know the home actually sold only 3 months ago, so we're going to add on 1%, which is a quarter of a year. The home is smaller, so we have to add in 60 square feet, which is going to be 1,200. In this particular case, it sold quite recently, so we're not going to be making any adjustment for market. But the landscaping is better, so therefore we've got to take away $1,000 worth of landscaping. And we come up with the final figures. And here we are. If we were to add all those up together and divide it by 3, we'll see the average is about 137. But we may say we're going to reconcile these 3 totals and improve them slightly due to the relevance or the representation that each home is to the subject property. For instance, I think that subject property number 1 is not a very good representation of the home, but it's the only one I can find, or the last one I can find, so I'm just going to apply 20% of the final price. Comp 2 is a lot better, and I'm going to apply 30% of the price there. And Comp 3 is even better. In fact, I quite like it. I wish they were all like that. I'm going to apply most of the price there, 50%. If they were all exactly equal, then it would be 33 1/3, 33 1/3, and 33 1/3. But I'm adjusting, or I'm weighting it, we say. Then I add all that up, and then I come to a final figure of 138,000, which is a little bit more. So this is probably more of an accurate figure. We also do property valuation using the sales comparison approach on vacant lots. I identify 3 vacant lots, or 3 comparables for my vacant lot. This is in the book. The lot I have is 110 by 120. I find 4 vacant lots of various prices. I divide it out by the actual square feet, and then I get a price per square foot on each lot. I could just add all those up and divide it by 4, but what I do is I assign a percentage of the appropriateness of each lot to my lot. I like the first lot, I'm going to apply 35%. The second lot wasn't so good, 30%. The third lot was not even so good as that, 20%. And the fourth lot was pretty awful, but it's the nearest one I've got, so it's 15%. Then I add all that lot up, and I come up with a reconciled amount per square foot of $294. My lot that I'm finding a price of, my subject lot, is 110 by 120. Multiply those out, and I come up with the reconciled adjusted value of 38,808. I'm not going to go through the questions, and then we'll end this and we'll go on to the cost approach next.